뉴욕나우. 안녕하세요. 글로벌 시장에서 통하는 투자법을 알려드리는 뉴욕나우 한국경제신문 강영연입니다. 오늘은 제이콥스 글로벌 리서치센터장과 함께 미국 시장에 대한 이야기 나눠보겠습니다. 요즘 시장 변동성이 정말 커졌는데요. 오늘 인터뷰에서는 주식시장의 앞으로의 방향성과 함께 올해 시장에 영향을 미칠 리스크는 무엇인지 이야기해보려고 합니다. 특히 금리 인상으로 한국 투자자들도 많이 가지고 계신 기술주, 그리고 암호화폐 등에 대한 우려가 커지고 있는데요. 어떻게 대응하면 좋을지 조언도 들어보겠습니다. 이 인터뷰는 현지 시간 1월 19일에 진행된 것이고요. 아직 FOMC 회의 내용이 발표되기 전이라는 점을 먼저 말씀드리겠습니다. 하지만 전반적인 시장 흐름과 견해를 참고하시는 데에는 큰 도움이 될 것이라고 생각합니다.
Yeah, it's a good question. We've been in a very strong equity market in the United States for several years now, and there's a lot of reasons for that. The US has economically been quite strong, even despite the pandemic. We've had a very accommodative monetary policy, which has kept interest rates low, and that's created a lot of buying pressure for equities. And frankly, we've seen pretty strong corporate performance. That profitability for a lot of companies has continued to grow, not just this past year, but frankly, over the last several years, we've seen profitability be very strong. A lot of those tailwinds that have helped these companies, I think, are likely to persist in 2022. But there are going to be some headwinds. That monetary policy support that we've seen is likely to reverse and turn into a headwind. Rising interest rates could therefore make equities relatively a little bit less attractive, and you could start to see valuations contract. Similarly, we're having really pretty significant inflation in the economy, not just in goods, but also in labor. And that's going to put a lot of pressure on profitability of companies because you can see their expenses are starting to rise very quickly. We're actually starting to already see that in the banks, that expenses related to retaining individuals at the firm has gone up significantly, and that's put pressure on margins. We think that could continue through 2022. So a little bit of a contraction in margins combined with lower valuations could mean that the S&P is only looking at single-digit returns this year. I think ultimately the S&P will still be higher by the end of the year. We still do have a very strong economy in the United States. I think we're still likely to see pretty good economic growth as we come out of the pandemic. We continue to see very strong innovation in the United States, which is likely to continue to propel the S&P 500 going forward. There's a very wide range in estimates for US economic growth this year, and probably the widest range that I can remember. Oftentimes, economists and banks are all relatively consistent. This year, we've seen everything from high 2% to high 5% in terms of total GDP growth. That just shows how much uncertainty there is out there. I think most people still expect positive economic growth in the United States, particularly amid the closing of the pandemic. But exactly where GDP growth ends up is going to be, frankly, very much driven by inflation and very much driven by whether we are truly out of the woods with COVID-19 yet or not. So there's unfortunately a little bit too much uncertainty to really determine how the United States will do, and frankly, how any country in the world will do as we continue to experience these lasting impacts of the pandemic. Yeah, we touched on this a little bit already, but I think the challenge for companies in the United States is going to be inflation and how effective they are passing that through to their end customers. In the services industry, we see a lot of labor pressure, which is going to cut into margins. Similarly, companies that are buying materials and raw goods, I think, are going to experience a fair amount of inflation as well. They'll try to pass that on to their customers, but it could be a challenge. So I think that's going to hurt some of the profitability of companies in the United States. Again, we still might see profitability. We might still see growing profits of companies, but this will just be a headwind that slows down some of that profitability growth. If we look at previous years, we benefited from extremely low interest rates, from the stimulus from the COVID-19 pandemic. We had the Tax Cuts and Jobs Act that reduced taxes back in a few years ago. So we don't have those same tailwinds this year. So we are expecting more moderated profit growth in the United States. Well, Well, a lot of things need to happen for prices to normalize. If we look at some of the biggest contributors to inflation right now, it's coming from energy, oil and gas. It's coming from new and used cars. It's even coming from rents. And so you really have to look at what are the kind of systemic issues that are creating that inflation. You have a lot of demand and we have challenges on the supply side. So if we see more oil production, which we could start to see coming online, actually, particularly in the United States, that could be downward pressure on oil prices. If we unlock some of the semiconductor shortages, that could put downward pressure on used and new car prices. And also, if you see more homes being built and more residences making available, you could start to see pressure on rents. But all of those things are not necessarily going to be addressed overnight. You can't just drill an oil well tomorrow or build a car in a day because you have a semiconductor. This is going to take time. And so I think we will see inflation start to moderate in 2022, but likely not until the second half of 2022 as we see supply chain issues worked through. And secondly, we see the Fed policy starting to shift and impacting inflation as well. I think inflation will probably moderate to about 3% by the end of the year. And that will probably be driven by the fact that the Fed will most likely, in our opinion, increase rates 4 times throughout 2022 and start to do quantitative tightening, actually reducing their balance sheet actively. Clearly, the Fed has changed their stance towards inflation. Until we have longer term supply chain issues addressed, they have to slow demand for goods by raising interest rates and making it more attractive for people to save. Basically taking money that's being spent and keeping it in the banks to reduce that demand pressure on prices. Yeah, we're expecting 4 times in 2022. There's some debate over whether it's 3 or 4. I know Jamie Dimon at JP Morgan said it could be 6 or 7 times. I think that's probably more out of consensus, but 4 times would be a meaningful interest rate increase. It'd be a significant departure from what people expected just 6 months ago. And hopefully that would be enough to start to slow down some of the inflation we've seen. Yeah, so we do believe that there's going to be a 2-pronged approach to the Fed's policy, which is first raising interest rates at the short end of the curve, and then secondly, allowing for their balance sheet to start to roll off. It's difficult to totally predict the timing of that, and I think they're going to first see the impact of interest rates moves and then make some decisions around QT. But we do expect at some point in 2022 we will see a decrease in the Fed's balance sheet. In many ways, we think technology stocks have been a bit oversold. If you look at some of the most impressive technology stocks from 2020 to 2021, some of them have sold off 20, 30, 40, even 50% just in the last few months with higher interest rates. If you purely try to model out how much interest rates have moved and the impact on these stocks, it does not justify that big of a sell-off. So we think there's a bigger rotation happening where there's just a lot of persistent selling pressure out of technology stocks and into more cyclical sectors like financials and industrials and materials that might be able to weather an inflationary period a little bit better. But frankly, we think this sell-off is a bit overdone. And for longer-term investors who are looking at the disruptive potential of these technologies, this could present a very good entry point. Frankly, one of the best entry points we've seen in the last 2 years for these technology stocks. One of the themes that we're very excited about in 2022 is robotics and artificial intelligence. On one hand, these companies have been around for quite a while. They have been focused on automating everything from manufacturing cars to manufacturing cell phones and consumer electronics. But if you think about where we are, we have labor costs rising. So there's a big source of demand to shift from human labor to automation. We have disrupted supply chains, which means a lot of companies want to bring production and bring logistics as close to home as possible, rather than depending on a globally diversified supply chain. And then finally, even though we are in a rising rate environment, overall interest rates are still extraordinarily low. So companies right now are really seriously considering investing in capital expenditures in robotics and automation to, first of all, lock in some of those low rates and to put that capital to work in automation to be able to reduce costs going forward as the divergence between the cost of labor and the cost of technology is starting to get wider and wider. It's one solution. So the challenge right now is that you have kind of a structural problem with the baby boomer generation retiring in the United States. It's the second largest generation in the US, and they are predominantly reaching retirement age. So the pandemic accelerated a lot of those retirements and brought people out of the workforce. But we're going to continue to see a lot of retirements every single year of the baby boomer generation. Now, fortunately, at the same time, you have the rising millennial generation, the largest generation in the United States, is now in between, being 21 to 42 years old and really starting to reach some of their peak earning years. So there's going to be kind of a structural headwind against the labor market. It's not just retirees. We saw a lot of women leave the workforce as well during the pandemic, and hopefully we can bring a lot of women back into the workforce to increase the participation rate as well. But those two factors, retirements and women leaving the workforce during the pandemic, has created a major supply and demand issue in the labor markets. You said it, automation, that could be one solution, but that's not really, it would help, and it could certainly, help companies in terms of depending less on human labor. But the reality is we're going to need to increase workforce participation as well. I think it likely will. I think there's a lot of demand for labor across the economy. I think labor can be more discerning in the jobs that they take in terms of either taking higher paying jobs or more flexible jobs or jobs that are more interesting to them. So we will see, but there's no easy fix for the labor shortage that's going to just happen overnight. Robots take a very long time to build, to put into place, to having them start to really contribute. At the same time, bringing in a new generation or bringing in people potentially from outside the United States to help work takes time as well. So there's no easy, Band-Aid solution that will fix this in just a few weeks or months. Well, there's several factors that we've already spoken about. Inflation is a major factor that will drive a lot of just how people view the markets in terms of what areas they want exposure to and what areas they might not want exposure to. We continue to see the pandemic playing out. Now, I think there's a lot of expectations that Omicron is a step towards the end of the pandemic as it's been weakened and vaccines continue to be spread around the world. But there's certainly still a lot of unknown around the pandemic. So if you consider inflation, you consider pandemic risk, both of those two are somewhat related as well. Those are two certainly very meaningful risks. I think third, we continue to see geopolitical risks, whether it's what we're seeing right now with Russia and the Ukraine and Eastern Europe, tensions around China, tensions even within Europe. So around the world, you have geopolitical tension, and that can always present risks to markets as well. Yeah, supply chain issues are likely to continue to be here for a while. Part of it is, there will continue to be shutdowns with Omicron. They might be more localized, they might be more temporary than we've seen with previous outbreaks of COVID-19, but it'll still cause some disruptions. The reason why the supply chain issues will never really be fixed while COVID is around is that we don't have a lot of slack in the supply chain. The supply chain was designed to work under very normal circumstances, and we live in anything but normal times. So unfortunately, we don't have the slack, we don't have the redundancy for supply chains to operate normally when you have shutdowns in entire cities or even of course entire countries. So until Omicron is over and until supply and demand normalizes, we're going to continue to see very difficult supply chain bottlenecks. Well, I think in terms of supply chain issues, I think supply chain issues could certainly last through the end of this year. Particularly, one of the things that we're looking forward to is the Infrastructure Investment and Jobs Act in the United States, which will improve the roads and highways and airports and seaports in the United States, really addressing the structural issues with supply chains so that they're more robust in the future. The problem is that takes time. You don't build an airport overnight. So I think we'll start to see some supply chain issues ease in the second half of this year. Inflation likely will come down because we'll see demand being reduced through rising interest rates. I think we'll also see COVID weaken significantly around the world, so we see less disruptions on the supply side. Hopefully that starts to balance out the supply-demand equation more. It seems like there's a bit of a divergence between East and West now in terms of dealing with COVID, where more Western countries in Europe and the United States are proposing policies that are more living with COVID, less aggressive shutdowns, more aggressive vaccines and testing, and treating it more like an endemic rather than a pandemic. I can't say what's right or wrong. I'm hoping that Omicron has been weakened enough and that we have enough treatments and vaccines available that it doesn't present systemic risks like it did in 2020. With that being said, we're dealing with something that is constantly evolving, and a very large outbreak or another mutation could start to change policy very quickly. So the risk is certainly still out there. It appears that things might be trending in a better direction and that we can potentially coexist with COVID, but we don't want to declare victory too early here. Well, by design, raising interest rates should reduce consumption and increase the savings rate. So, we'll see how effective that is. I think if there are 4 interest rate increases in 2020, that should be pretty effective in actually starting to move the needle in terms of more people considering savings in their bank accounts. But we'll have to see. It's a delicate balancing act for the Fed to reduce consumption somewhat, to keep a lid on inflation, but to not impact the economy too negatively in a way that it starts to cause layoffs or economic uncertainty. So that's why this is going to be a gradual process by the Fed. And I don't think they want to do too much too quickly until they can understand the impacts of interest rate increases. What I think is the best place to look right now is in disruptive technologies. And we talked a little bit earlier about some of the sell-offs we've seen in disruptive technologies. Many of these themes like cloud computing, cybersecurity, telemedicine, and fintech have seen pretty substantial sell-offs, but at the same time, their expected growth rate going forward really hasn't slowed down. The use case of these technologies is as high as ever. We see consumers are adopting these technologies faster than ever, and we see a very quickly changing economy with more digitalization, the introduction of the metaverse, and bringing more and more things online into a digital environment. So when you combine all of that together, I think the best place to put money right now is to buy the dip on some of these technology stocks, accept that there will be volatility. You can't avoid the volatility. But as a long-term investor, I think investors will likely be rewarded for their patience in this space. I'm not in charge of it, but we are building several cryptocurrency funds in Global X right now. Sure. Well, what we've seen over the last 2 years is a really broadening of the cryptocurrency market. So we did a survey of consumers. 2/3 of consumers that are invested in crypto came into the markets in the last 2 years. Also, if you look at Coinbase, one of the biggest exchanges for cryptocurrencies, through almost 3/4 of their trade volume is now institutions. So we have a lot of new people coming into the crypto markets. We also have an institutionalization of the crypto markets, which is bringing in more professionals. All of this is making for a much more robust ecosystem for cryptocurrencies. It's not just a small group of people. It's not just retail investors. It's broadening. It's becoming more inclusive of different types of investors, and it's getting professionalized. So we will absolutely see volatility in the crypto markets like we have for several years now. But cryptocurrency is here to stay, particularly some of the largest, most accepted cryptocurrencies, because of how many people are involved in investing in the space now. Over the long term, we absolutely do. What we believe is that more and more investors are going to be using cryptocurrencies as an alternative investment in their portfolio. That means, it might only be somewhere between 0 and 10% of their portfolio, but it would be in there as a diversifier in the portfolio because it's just not going to behave like equities or fixed income or some other traditional asset classes. So when you see just the potential of even as simple as 0 to 10% allocation in portfolios around the world, it creates a massive tailwind for cryptocurrencies going forward. There's so much volatility in the cryptocurrency space. I can't, purport to be particularly adept at timing it, but I think investors that again take that long-term view of crypto, maybe are patient with their investments and buy in increments over time, dollar cost average, that people can do well over the long term.